Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. Sensex and Nifty follow global cues and tumble after Fitch downgrades US credit rating. 3 lakh crore in investor wealth wiped out. Only 4 Sensex stocks managed to end in the green. In a shock move, ratings agency Fitch lowers the credit rating of United States, cites steady deterioration in governance over the past 20 years. Business Today TV tells you what the move means for India. Indigo flies high above financial turbulence, reports its highest ever quarterly net profit of 3,090 crore rupees in Q1, gains big from the vacuum created by the grounding of Go First. SpiceJet to convert dues of aircraft lessor Carlyle into equity will issue 5.91% stake at 48 rupees a share. That's more than 65% higher than yesterday's closing price. Share zooms more than 7% today. Maruti now the #1 SUV company in the country. New models barrel it past competition in July. The big worry is a sharp fall in the bread and butter mini car sales. We have a conversation with Maruti on the show today. Let's take a look at how the Sensex and Nifty performed today. Let's take a closer look at all of the market action. A bloodbath on D Street as benchmark settled sharply lower today, the Sensex setting below the 66,000 mark and the Nifty barely managing to hold 19,500. The sell-off followed the downgrade of the US government's top credit rating by rating agency Fitch. Profit booking also played its part, and for the day, markets plunged. Sensex was down almost 700 points. Nifty was down over 200 points as well. We had a few gainers, just a handful: Divi's Lab, Nestle, HUL, Asian Paints and Tech Mahindra. Minor gains. On the losers list, Hero MotoCorp, Tata Steel, Tata Motors, Bajaj Finserv and NTPC. Let's go across to Sakshi now. Sakshi, what are some of the big reasons for the fall in markets?
Well, that's right, Abha. The Indian markets crashed sharply today with the Sensex tumbling over 1,000 points on an intraday basis. Both the Sensex and the Nifty ended deep in the red, down by over 1%, but off the lows of the day. The volatility index also rose sharply by 10-odd%. All the sectoral indices ended in the red as well. Investors, in fact, lost a whopping 3.5 lakh crore rupees of wealth in today's trading action. So what really spooked the D Street today? 5 key factors. To start off with, it was the Fitch rating downgrade of the US. The US was stripped of its top-tier sovereign credit grade by Fitch Ratings, which criticized the country's ballooning fiscal deficits and erosion of the governance that actually led to repeated debt limit clashes over the past 2 decades, and that was the primary reason for that. What led to this was the weak global cues. We did see that the US markets ended mixed last night, with the Nasdaq ending almost 0.5% lower. And then it was the US futures that actually reacted to this Fitch rating downgrade that actually pulled the Asian markets lower in the morning trade by almost 2%. And then the FII outflows, after pumping in about 1.5 lakh crore rupees in the last trade over FY24 so far, the foreign institutional investors have shown some signs of exhaustion. In fact, FIIs have turned net sellers over the last 4 trading sessions as per the NSE data, having pulled nearly 6,000 crore rupees worth of funds from the Indian equities, even though this was offset by the buying of the same amount and even higher by the DIIs. Remember, profit booking was another reason. July was the 5th consecutive month in which the Nifty ended on a positive note, and the market has rallied over 13% in the last 5 months, giving impatient investors a chance to book some profits when the market showed some signs of fall or a decline. Now, we did see valuation concerns also simmering in. The one-way rally from the March lows had also brought valuations under stress and left little scope for any upside of the rally too. As per Axis Securities, the Nifty is currently trading at 18.8x on a 12-month forward PE. That's definitely on a larger side or a higher side when we compare to the average valuations, and that led to the fall as well. So these were the key 5 reasons that pulled down the index today.
Catch top market guru Samir Arora on Business Today TV very soon. Send in your questions on the number on your screen by 4 p.m. Friday. Rating agency Fitch late on Tuesday downgraded the U.S. government's top credit rating, leaving American authorities furious. The downgrade drew angry responses from the various wings of the U.S. government and left investors surprised. What does this mean? Here's a complete report on the implications of Fitch's latest move.
It is the largest economy in the world, with the dollar, the Fed's interest rates, the bond market, all benchmarks for the world to follow. Now Fitch is one of the three big global rating agencies has, in a shock move, downgraded the US government's top credit ratings to AA+ from AAA. Citing fiscal deterioration over the next 3 years and repeated down-the-wire debt ceiling negotiations that threaten the government's ability to pay its bills. According to Fitch, there's been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters. It added that the repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management. Also, the report said that the US government lacks a medium-term fiscal framework, unlike most peers, and has a complex budgeting process. These factors, according to Fitch, along with several economic shocks as well as tax cuts and new spending initiatives, have contributed to successive debt increases over the last decade. The US administration's response to the economic thumbs down was immediate. US Treasury Secretary Janet Yellen said she disagreed with the downgrade, calling it arbitrary and based on outdated data, adding that the US Treasury securities remain the world's preeminent safe and liquid asset and that the American economy is fundamentally strong. White House response was purely political, blaming the downgrade on the previous Donald Trump government. The statement also termed Republican loss a threat to the US economy. According to analysts, the US rating downgrade is an extraordinary thing and has potential for a global impact. It could raise interest rates on US government bonds, which could result in higher interest payments on the national debt, putting additional strain on the government budget. This could affect the overall economy and erode investor confidence, leading to negative market sentiment. This downgrade may also dent the stability of the US dollar, which will influence the movement of global currencies with respect to it. Bureau Report, Business Today Television.
Business Today TV Sakshi Batra spoke to market analyst Hemang Jani earlier today and asked him what impact the downgrade would have on India. Listen in.
Yes, I think the main trigger that is coming for the correction that we witnessed today is the downgrade by Fitch of the US economy, wherein because of the growing concerns about the way the debt has grown and the way the government there is not able to resolve certain debt related issues in terms of the limits and the overall debt ceiling which is there. There is a sense that maybe there could be some amount of risk because of that, and which has actually triggered off the correction in our markets. I think, Sakshi, we should not overplay or give too much of importance to these kind of developments, because credit rating agencies typically are behind the schedule when it comes to taking any decision in terms of the rating change. And the market is forward looking. So sometimes, there can be a knee-jerk reaction because of these kind of developments. But I do not see this necessarily as a reason for a deeper correction for our markets. The interest rates are linked to the rating that the sovereign country gets. Also, many intercorporate transactions are also linked to the credit rating that, the corporates have. So to that extent, it has some impact on the interest rates per se. But the market, as I said before, is forward-looking and would have already priced into a great extent, because if you see the 10-year bond yield movement in US, it had already touched about 4. So market was actually anticipating such a move. And I think maybe temporarily you might see the 10-year bond yields really spike up, and to that extent it would have some negative rub-off on the market. But I do not see this as a major negative for our own markets.
The 51st GST Council meeting was held in Delhi today. One of the biggest issues on the agenda is a clarification on how 28% GST is to be implemented on online gaming. The gaming industry has vehemently objected to the additional tax which was decided in the last council meet. Let's listen in to the big decisions today.
Decision to amend the CGST had these dissenting voices. Delhi on online game, casino for Goa and Sikkim, and Tamil Nadu on online games having been banned. What are your changes going to affect us like? So they wanted a language to be put in saying where the ban has happened, obviously tax cannot be levied. So on that, Revenue Secretary had agreed, saying that he will give a language in the amendment so that Tamil Nadu's ban is taken cognizance of even in the amendments. So that is where today's outcome is. The Secretariat will work together. We'll get an amendment to the CGST taken up at the earliest, hopefully even in this session. And when the question of when to implement it came, 1st October is when it is expected, by which time the states also will pass their amendments to their state laws. And because on the casino, Goa and Sikkim kept appealing, saying we are small states, we need to be given a consideration. Andhra Pradesh FM also said we should have large heart and help out small states. The council agreed today to come back after 6 months to review the way in which this is getting implemented.
The Finance Ministry has tabled a list of the top willful bank defaulters in Rajya Sabha. According to the list, India's top 50 loan defaulters owe 87,000 crore 295 rupees to banks and financial institutions. The banks have also written off more than 10.5 lakh crore rupees during the last 5 years. Among defaulters, fugitive Mehul Choksi's Gitanjali Gems tops the list with 8,738 crore rupees in dues to banks, followed by ERA Infra Engineering, which owes close to 6,000 crores, REI Agro with about 5,000 crores, ABG Shipyard also close to 5,000 crores in dues. Comcast Steel and Power close to 4,000 crore rupees, and that completes the top 5 list. Others include Rodomac Global, Winsome Diamonds, Frost International, Sri Lakshmi Kotsin, and Zoom Developers Private Limited. July has been a mixed bag for Maruti. While it achieved its dream of being the biggest SUV player in the country, sales of the company's bread and butter mini car models plunged 52% on year. However, the good news is that the crippling semiconductor shortage is receding in the rearview mirror. As BTTV's Chetan Bhutani found in his conversation with Maruti Suzuki's Senior Executive Officer, Shashank Srivastava.
Yeah, so it's been actually one of the positive things that emerged in July regarding the UV sales was, of course, the semiconductor crisis, which we were battling, the whole of last couple of years, and Q1 seems to have eased a little bit. And as a result, we could produce some very good numbers for Ertiga and XL6. Also, we could get much better supplies, the Brezza and the Vitara. The Fronx also continues to do well. And those are reflected in the very good growth numbers that you just mentioned. And also in terms of the SUV market itself, we have done, I think we have made good progress towards our stated objective to be the #1 manufacturer of SUVs. In fact, for the month of July, we were the #1 SUV in terms of the sales. We did about 42,600 units against the next biggest player. That was around 36,000 units.
So is it bothering you about the plunge in mini cars and small compact vehicles sales being plunging? Although SUVs on the revival of Maruti and record numbers have come, but yes, does a decline in sales worry Maruti Suzuki?
I wouldn't say worry, but yes, if you look at the overall market construct, while still the segment is large, I mean, 13,40,000 vehicles were sold last year in the small car segment, which is a pretty large segment. And it becomes important to us more so because we have a 70% share in that segment. So from that perspective, this segment, both in terms of volume and the market share, is very important. That's the reason why we want to continue to consolidate in this segment while we get into the new segments like the SUVs, where admittedly we have been weak historically. But now with these four models, I'm happy to say that we could achieve almost 25% share in July in the SUV segment as well. So yes, I would say it's like you have to devise a strategy according to the market movements.
Is the rural India, rural Bharat consumer pushing the purchase to a later date when the vehicles become more affordable, or the trend would be like this?
Yeah, so I think there are a couple of things which are happening, and it's not just one trend that we can talk of. In terms of the body shape preference, yes, it seems to be a general trend towards the more SUV-ish, strongish, upright driving stance type of vehicle with high ground clearance, which is what the SUV offers. So that trend is a body type preference trend is there. On the other hand, you also see the trend in terms of the income levels going up in the rural areas. So combined with that, you would see the rural growth, for example, in our opinion, should continue to be robust. If you look at, for example, April to July period, the growth in the rural areas has been about 12%. In the urban areas, it is 8.6%, and combined, it's about 10.3%. So still rural growth outpacing the urban growth. In rural, actually, in the month of July, for example, the growth was 18.6% against 14.2% growth for the urban area. So the preferences obviously will depend on how the economy in the rural areas work. There seems to be a lot of positives which we observe, but of course, we'll have to wait and see how it pans out.
So the company has, of course, now become the leader in the 10 to 20 lakh crucial segment. With the Invicto coming in, how soon would you be able to capture a significant portion of the 20 to 30%, the second hottest probably segment for the SUV?
So the 20 to 30 lakh segment which you are referring to, where the Invicto is playing, is roughly around 4.5% of the overall market. So it's still a small market, but it has been growing. In just a couple of years back, it was about 2% or slightly less than 2% of the overall market. So yes, there is a substantial jump in that segment, although in absolute volume terms, it may not be large at the moment. But the Invicto that you mentioned, we have about 10,000 bookings now of the Invicto, and it's really about how quickly we can supply these vehicles if we have to garner the extra market from there. First month we just could do about 500 vehicles because that was the total supply available. So if you do that rough calculation, it seems to be a pretty big and long waiting period. However, we are, discussing with Toyota on how to get more Invicto so that we can get not only good volumes there, but also reduce the waiting periods.
Gold demand in the country this year could fall to its lowest level in 3 years. The World Gold Council has said that with prices of the yellow metal at record highs, dampening retail sales could translate to a 10% fall this year. My colleague Sakshi Batra spoke to Mr. Somasundaram, PR, Regional Chief Executive Officer of the Gold Council, about the precious metal and its outlook. Here's an excerpt.
Well, let me just bring out the point where you have mentioned in your report that gold demand in India particularly, which is the world's second largest consumer of gold, has in fact slipped in Q2 of the calendar year. Help us with the reasons behind the same.
Well, as we have stated, it's largely to do with the price. As the prices have shot up very fast, consumers tend to stay on the sidelines to see whether this is a blip or is it a sustainable increase. It always happens. Volatility is good for the trading community. It's not good for the consumers. So that is what has really happened. On top of it, there have been other factors as well. Probably a little bit of inflation has bitten into the incomes, and that must also have reduced the amount that people could afford to buy gold. But primarily, the high prices, in fact, it touched something like 64,000 rupees in Indian rupee during the quarter. where gold prices were literally unaffordable for many people. That must have been the biggest reason. And to give you an indication, gold prices have gone up by nearly 12% above the prices of last year's same quarter.
Okay. Sir, can the second half demand be even worse than the first half? What is your own sense here?
Well, generally, second half is the better half in every year. This is a general rule, although we have seen even quarter two, sometimes Akshaya Tritiya just exceeding expectations. Generally, in the Indian demand is such that second half is the biggest quarter. And within the second half, the fourth quarter, when you have generally Puja, and then Dhanteras and others coming in, and then the wedding season. This is how it is. In fact, fourth quarter is something which everybody looks forward to when it is in the jewelry business. Now, it is the third quarter, part of it is lost in monsoons, because generally in monsoons, unless there is something like a significant price drop or something, people tend to focus on other stuff. And towards September, of course, it comes back with Ganpati festival. So the 4 months of the last year are very important. So it will always be higher than the first half.
And that's where we leave it on the show tonight. Thanks so much for watching.